Welcome to episode 77 of Accessible Finance. Let's dive in.
All right, Eric. So today we are going to discuss a question that we hear a decent amount from our clients who are very close to retirement, which is, I'm planning to retire next year or in the very near future. How do I reduce my tax bill before I stop working? What can I do now to lower my taxes?
Yeah.
So what's the first thing someone in this situation should be looking at?
Deferral, right? So if you're in your last earning year, you're typically going to be earning. This is usually one of your higher earning years, right? Mm-hmm. So you're going to want to try to defer as much of your salary right now as possible and start to plan for how to situate your money within your taxable accounts and your tax deferred accounts, likely to execute some series of Roth conversions.
We can't get through an episode without talking about it.
I hope not. There were a few where we didn't talk about Roth conversions, and honestly, it was terrible.
I know you went through withdrawals yourself. Okay, so then let's talk through some of the key moves and what they should be prioritizing before that paycheck stops.
Okay, this is one that's kind of interesting, right? So, you want to max out your pre-tax accounts, which pre-tax accounts that are deductible, right? We're not telling you to go make non-deductible contributions like crazy. You actually would probably rather that money be in a taxable account so that you can pay taxes on conversions later. And what I mean by that is, I think it's 23.5. I should know. I'm 98% it's 23.5 contribution to, actually, if you're about to be retired, then it's going to be more than that because there's a catch-up contribution. It's over 30. Anyway, sorry.
It's going to drive him crazy.
It really is.
Yep.
Look it up. Go. Quick.
Oh my gosh. You need to keep speaking.
All right. The catch-up contribution is the most that you can defer into your employer's plan, right? But you're still going to, after that, there's typically a non-deductible after-tax contribution that you can do for strategies that are like the mega backdoor Roth. But essentially, I'm saying that you don't want to make non-deductible contributions. You're looking for deductible contributions, right? So typical contributions to your, or deferrals to your 401k plan. Sorry, lots of words.
Indeed.
Yeah.
Okay.
You also, this is the kind of interesting part. If you know that you're charitably inclined, right, you can accelerate your charitable contributions by using like a donor advised fund. If you know you're going to do that anyway, then you can do it now when we think that your taxable income is the highest. And what that means is a donor advised fund is a strategy where if I know that I'm going to give $10,000 a year to charity because I'm charitably inclined anyway, and I like it, I enjoy it, and I feel like it, I feel good about it, I'm going to do it anyway. If I give $10,000 a year, that's below the standard deduction. So I might not get any taxable benefit, right? I still feel good about it. It's still a charitable act. It's still a good thing to do.
But you're hanging out with standard deduction.
Right. But I'm doing that every year. I'm doing $10,000 a year to no tax benefit.
Right.
Okay. Because the standard deduction exceeds, it's $14,000 plus. It's going to exceed the $10,000 that I'm giving to charity.
Yeah.
And if I don't, I no longer have a mortgage, I don't have health expenses over 7.5% AGI, I might not be able to itemize. Okay. Which means I might not be able to use any of the things that I would ordinarily deduct if I did itemize, since I'm taking the standard deduction.
Sure.
Long-winded way to say, if there's no benefit to giving your $10,000 a year, you might want to front load it and say, hey, you know what? I have $100,000 maybe lying around. Why don't I just give $100,000 to a donor advised fund, and then over the next 10 years, even assuming no interest or earnings on that $100,000, which doesn't have to be the case.
Right.
Point is, then over the next 10 years, I can give the $10,000, and I can take that whole $100,000 deduction right now when my tax bracket is the highest.
Putting it in the donor advice fund.
Exactly.
And to be clear, I think, we've talked to clients about this as well. At some point, there was some misunderstanding that went viral on social media that donating money ends up actually saving you money. And so we would never advocate, setting up a donor advised fund for the purposes of saving you money. However, like Eric said, if it's something that you are inclined to do anyway, then there is a way to also benefit from that decision that would be made regardless.
Right. Yes. Just to be clear, the point that Rachel's making, and she made it well, I just want to reiterate, you will not net positive by handing dollars to charity.
Yeah.
Does that make sense? Even if my tax rate, on my $100 is 99%,
Yep.
Okay. And I hand $100 to a qualified 501c3. I now, if I hand the money to charity, I lose $100. Okay. If I pay the money to the government at my 99% tax rate, I still have my $1 left.
Yeah.
I will always come out worse by giving the money away from a how much do I have at the end of the day perspective.
Sure.
Not from a did I do the right thing? That's
Correct.
completely agnostic to that right now.
And I think that, if you're working with a advisor or planner, hopefully they're not imposing their own views or opinions
Correct.
on you, right? So
Right,
you should
right. No,
never
these are your
be made
values.
to feel badly for not choosing a donor advised fund or for choosing a donor advised fund, but you should definitely know the pros and cons, the benefits, and how to maximize the benefit to you if you're
Right.
doing it anyway.
Right. And
Okay, sorry. Side
so
tangent.
latter point. So we said maximize your deferrals
Yep.
to the 401k. Okay. Again, it's over $30,000 for the catch up. Accelerate your deductions if you're going to have any. It's mostly going to be charitable, right? There are others, but probably not. And then you want to, if you're going to have bonuses or, vesting schedules or anything like that, if you can push
Payouts,
them
yeah.
out, if you have RSUs, bonuses, any kind of compensation packages, if you can defer them, it is to your advantage because we just said you're retired next year. And unless you have, taxable accounts that are producing dividends and interest, you're probably going to be just much lower, just dramatically lower, right? Especially if we're talking about somebody that's in the 37% bracket, making $400,000 or $500,000 or more, you're going to be thrown way down into the potentially even the 12 or the 22% bracket.
So if we're thinking back to last episode, and you're getting potentially thrown down into a lower tax bracket the next year, what might we be thinking?
Roth conversions. This is so you want to have a strategy, right? We want to ideally we can math out exactly what we should do because we know when we're going to receive our Social Security.
Yep.
We can know what that number is, what we're going to receive in Social
you
Security.
should know all of
We know
this.
how much is taxable of the
Correct.
Social Security. We know that it's almost always going to be 85%. But the point is, we can know all of these things. We can know when your pension is going to kick in if there is one, when your RMDs are going to kick in. We can actually use discount rates to have a pretty educated guess as to what those numbers even are going to be. We can quantify that. So the point is, we can have like what we would call we can do laddered Roth conversions, right?
And to be clear, that laddered Roth conversion would start once you have retired, not in
Absolutely.
the year that you are. Much to
Correct.
Eric's dismay, he'd have to wait.
No, I would absolutely be happy to wait in this case.
But if you are in your, like Eric had said, right? If you are rounding out your career, you're at your highest earning potential at this point, right? You are making the most that you're going to make. This is the worst year to sit there and say, let's do a Roth conversion. However, you know that your bracket, right, your income that you're realizing is going to dip down pretty dramatically in most cases at the point in time that you have now retired.
Right.
So that is a huge, huge planning opportunity for Roth conversions.
Correct.
You
Absolutely
search something
important.
up.
Yes. I just wanted to be clear that it was $23,500 for younger individuals under 50, right? But if you're 50 or older, you can defer $31,000. Okay, to your 401ks.
I love that. Thank you.
So if we're talking about nearing retirement, we're going to assume that they're 50 or older. So we're going to assume $31,000 is the number you can defer from your salary to the 401k account.
Perfect. Now, okay, so even though this, these people, these clients have come in and said, hey, I'm looking to retire. How do I lower my tax bracket now, right? How do I lower my taxes now? We end up having to do, a decent amount of education and discussion around the fact that it's not about saving on taxes this year. It's about saving on taxes over your lifetime and setting your entire future up for success when your income drops. So how would you try to talk to them about kind of bracket planning?
The way I like the phrase that I use that I'm sure listeners have already heard is effective marginal effective tax rate.
Yep.
Okay. And what I mean by that, I'm not trying to be cute. It's just your marginal tax bracket, right? So if I'm in if the last dollar that I earned is taxed at the 22% bracket today, my marginal tax bracket is 22%,
Yep.
right? If in the future it's going to be 32, right, or 24, okay, well now there's a little bit of a difference there.
So we're not talking
So
like
we're just talking about 22 versus 24. We're talking about the last dollar of tax.
Yeah, I think that's an important thing. And we've talked about it before, but typically when people will see their marginal tax bracket, they'll assume that's the average
tax they
that
pay
they're
on
paying.
everything.
Correct.
Not the same. No.
There are that's why, I'd referred to it as bracket planning, but it's exactly that. It's the fact that you're paying X amount of dollars in the 10% bracket, X amount of dollars in the 12%, and it moves on and on and on. The idea is to prevent you from having to pay a single dollar in one of the brackets that we would kind of refer to as like the red zone or like
Right.
the really high bracket, if
Correct.
we can avoid it.
We're trying to reduce your effective tax rate, which is just your total taxes paid over your taxable income. Okay. And what we're going to do when we say we're talking about marginal effective rates, like what are you actually talking about? We're including two primary things, but we're basically including everything that's going to have a tax impact. So if you earn too much to qualify for the child tax credit and you have, two kids, that's $4,000 you're not able to take.
Yeah.
Okay. So we want to count that $4,000 as an additional tax that you're paying because it's an opportunity cost of earning so much money.
Yeah.
If we could make you somehow earn less money or have less taxable income, it's not like we want to make less money. We never want to do that.
No.
We want to try to defer or contribute to tax deferred accounts.
We want to realize less income.
Exactly. We want to reduce our taxable income so that we can qualify for all these credits, right, and deductions. And then we want to try to use a little bit of tax rate arbitrage around things like IRMA. So I mentioned child tax credit, but the two primary in retirement or as individuals approach retirement are going to be IRMA, which is the Medicare premiums that you would pay. So there's a baseline premium, and then there are flat cliffs. What I mean by that is if the cliff is, $190,000, okay, you're completely fine if you make $189,999.
Yeah.
Absolutely fine. Don't pay that. And then if you make one more dollar, okay, now you're paying an extra $1,000 in premiums a year, right? That's just how it works. Okay, so they're cliffs. So what we want to do with things like income manipulation is to move right up to the cliff but never hit it. So we want to give ourselves a little bit of leeway there and not hit that. But IRMA brackets and then net investment income tax are the two things that are going to increase your effective tax rate over your marginal rate primarily, right? Those are the two chief offenders.
And now if listening to this is making your eyes glaze over, you're not alone. I will say that I have met nobody who is as excited about talking about this as Eric is. But
this is some very engaging and compelling conversation.
Very dynamic.
Everyone
but I will say that it is incredibly specific. When we are using our planning software, it is in the amount of data that is needed and that you have access to be able to avoid hitting these like hidden landmines, right? Specifically net investment income and then IRMA is available. It's there, but it does require very specific knowledge and understanding of what contributes towards those numbers as you're making your way towards that cliff. Like Eric said, once you've crossed it, there's no going back. There's no undo button. You're there.
And what's kind of interesting too is IRMA has what's called a 2-year look back. So what you did 2 years ago matters. And we have to actually kind of try to play around with what we think the inflation rate's going to be over those 2 years. It gets a little bit granular.
Yeah.
It's a little bit hard to math out exactly, but the idea is I guess that's why our profession exists largely, right? So point is though, your takeaways at home, you want to think about having enough in your taxable account to A, support your cash flows, and B, potentially pay taxes on your Roth conversions. Really just pay your taxes in general. But the Roth conversions are going to make you incur higher taxes than you would otherwise. The idea is we're trying to pay more taxes because we think that our rates are lower now than they will be later when we're potentially taking RMDs from these huge tax deferred accounts, right? So when we execute these Roth conversions, we're actually reducing our tax deferred balances and therefore lowering our RMDs when they do kick in the future. Does that make sense?
Yes. And for those, I think it's worth
lots of acronyms and
I think it's worth touching on RMDs and kind of how they are, that it's not a flat number.
Right. No, it's not just like 4% of your account a year, right? So the divisor, right? So the first year is what, like 25? You divide it by 25. You divide your like total, IRA balance by like 25. And then that's going to be ballpark what you pay as an RMD. And then that divisor goes down to where like if you're like 110 or something, it's just 1. They make you take the rest of the account as your RMD. Or it doesn't, I don't know if it actually hits 1, but it's real close. 1.2 or something.
Yeah,
right?
it goes up pretty quickly. Because again, the government's not going to not collect on their the taxes on that money.
Right. So they're making you take the idea is you have to take more as a percentage of your account. You take an increasing percentage of your tax deferred total account balances the older that you get. Mm-hmm. Right.
Yes, it is. It's something that I think we'll see. You know, again, this is the scenario with clients coming in saying like, "Hey, I'm really worried. I'm going to be retiring next year. What do I need to do now to set myself up for success?" And the reality is that there's so much to do in that year before retirement, but there's also so much to do in the years before the year before retirement. And there's so much to do in the years after retirement as well. So
I was wrong, by the way.
you're
if
not
anybody's
handicapped, but
at age 110, you're not required to take the entire account. You're required to take half of the account, the divide 2.
it just keeps cutting it
Right.
in
But
half.
like the first year, if we're thinking that the first year is 73, you have the divisor 16.4. The idea is the divisor starts larger and becomes smaller so that you take a higher percentage of your
what's
account
left.
over time.
Yeah. Perfect. So exactly. I think that the, biggest takeaway here is that preparation is key. If you're waiting until the year right before retirement, it's less than ideal, but you're
Correct.
at least preparing
Correct.
somewhat.
Yeah. We can at least try to start moving some funds around, make sure our taxable accounts are funded. Try to consider what we're going to defer, what we can afford to defer, because we might not have sufficient taxable balances anyway. There's a ton of planning to be done at this point in time. Maybe it involves working another year because our taxable balances are so low and we've deferred too much, and we're looking at tax planning and just feel a little bit more comfortable with it if we have a little bit higher balances.
So how far, Eric, in advance would you think would be an ideal time to start considering working with a financial planner? If you know, okay, I'm going to retire, how many years out from retirement should I be looking to start this planning process?
That's a good question, especially because a lot of people tend to not fully retire, right? We would encourage, staying active and staying involved in things that you care about and that you enjoy.
For sure, whether it's part-time work or
exactly.
not.
And so it depends is the the answer that nobody wants to hear.
Give me
maybe 5.
I was
say 5.
I was thinking 5 too. And again, this doesn't even mean necessarily that you have to work in earnest necessarily with a financial planner. But if you're 5 years out from retirement, it's certainly worth taking some meetings,
because
talking about what things to do, seeing what information is out there, and trying to find the right fit too. Because if you're trying to find somebody that you trust and is the right fit in a pressure cooker time, you might end up in a situation that
correct
is less comfortable for you.
Yeah, you want to work with somebody that you're comfortable with. I would also say that it's important when you think you're 5 years out to work with a planner, because you might not be 5 years out, or you might be 5 years out, but instead of spending $100K a year, you got to spend 80.
Yes.
Does that make sense?
That's a great point.
Maybe I'm actually fine now, and I thought I was 5 years out and I could spend 100, but I'm actually, if I'm 5 years out and I earn what I'm earning, I might be able to spend 120 or 130. So I'm happy to I might be ready to cut now.
That's a great point. I think that for so long, traditionally, people retired at a certain age just because that was the factor that we used. And that's no longer the case. We're seeing people retire at all ages. We're seeing people who enjoy their jobs and who want to stay on for longer.
It should be a function of account balances and things rather than, just a number. It certainly should not just be a number.
Arbitrary. Yes. No. Correct. So exactly. I think that, if you're working with someone a year out from retirement, that's great. If you're a few years out from retirement, it's probably worth at least reaching out.
Yeah, explore. See what it's like.
Yes. Take your time. Perfect. All right. Well, if you're feeling overwhelmed by any moving parts that we talked about here, or if you have your own question, please don't hesitate to reach out to us at podcast@equilibriumfp.com.
All righty. Thanks, guys.
Till next time.